Thanks for clicking. Canadian mortgage stresses are continuing to mount. This according to a plethora of news reports that have been making headlines over the past week. And the news of continual mortgage stress comes as Canada's local real estate markets are reporting major increases in new listings, but a dearth of buyers, with TD and Capital Economics both predicting price decreases going into 2024. And it's not just TD and Capital Economics that are predicting price decreases going forward, with realtors John Posthaste and Steve Soretsky admitting publicly out loud that even a lack of supply and high immigration won't be enough to prop up prices. So what I want to do today is go over some of the stresses that are showing up in the mortgage market, take a look at where the banks, Posthaste and Soretsky see the real estate market going, and then discuss what to look for next. Speaking of next, the direction of the housing market is all going to be heavily based on the Bank of Canada's next rate decision coming up on October 25th, which will be heavily influenced by the CPI release coming out next week. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgages. On to the reports, which, as mentioned, are revealing growing stresses in Canada's mortgage market. The Globe and Mail recently interviewed 8 different couples, all revealing growing problems on the part of homeowners due to higher interest rates. One couple from my hometown in London started out their mortgage at 3% and, upon receiving their renewal, will now be at 8%. Now, the details of that mortgage aren't specified in the article, but just doing a very brief comparison, if the couple had a $500,000 mortgage and a 25-year amortization at 3% on a 5-year term, at the end of the term, they would have had $435,000 owed and had a payment of $2,366. But now renewing with 20 years left in an 8% rate, that payment is going to jump up to $3,610, a $1,300 jump in their monthly payment at the time of renewal. Now those borrowers may, and I stress may, have the option to extend out to 30 years, but they will have to requalify in order to do so. And with an interest rate of 8%, having to requalify at 10%, that's definitely a tall order. And this couple isn't alone with having stresses at renewal, with 1 in 5 borrowers expected to have to renew their mortgage over the next year, for a total of $200 billion in mortgage renewals coming up. But it's not just those renewing their fixed-rate mortgages that are having trouble. The Globe spoke to another couple who took a variable rate mortgage in February of 2022 and have seen their payments shoot up from $2,500 to $6,000.
This time it's different.
The Globe also spoke to a real estate investor who is now considering selling her properties, as the cost of servicing her mortgages have tripled, and many of her properties are now losing $1,500 to $2,000 per month. So we're seeing major stresses on fixed rate holders coming up for renewal, on those with variable rate mortgages, and for investors whose properties no longer cash flow. And these stories of growing mortgage stress, which coincidentally come 9 months after a poll was released that said 45% of mortgage holders would have to sell in 9 months, come as local real estate data is showing a major surge in listings across the country, with Toronto seeing a 44% increase in listings, 28% in Vancouver, and 10% in Ottawa. In fact, as we've covered before, Toronto's sales to new listing ratio is at the lowest point that it's been since the 2008 financial crisis. Ottawa's listings are 5% higher than its 5-year average and 7% higher than its 10-year average for the month of September. In London, listings are up 19% since this point in time last year, 22% from the year prior, 14% from 2020. You get the idea. In fact, we're seeing reports of a record number of listings all over the place. And while, as we've talked about before on this channel, we're not going to get any data points that say that this major upsurge in new listings, well above typical levels in the GTA, are from distressed selling or from anticipatory selling, a recent report from RBC said that soaring interest costs are no doubt prompting a growing number of owners to move. And with more inventory coming to the market and demand just not there, predictions of price decreases are mounting. Although TD is predicting that we should see a relatively orderly increase in the number of new listings coming to the market, even with that prediction of a modest increase in supply, which may not be the case, TD is predicting a 6% drop in real estate prices from their second quarter levels. Stephen Brown of Capital Economics echoes that of TD, noting that recent rate hikes have reduced affordability by 13%, and now it's much more likely that we're going to see prices decline going forward. And while TD and Capital Economics are only considering price decreases in terms of a lack of affordability, GTA realtor John Posthaste says that it's not just a lack of affordability that is going to put downward pressure on prices, but also a major increase in supply, brought on by potentially distressed selling.
Only thing that matters right now are interest rates, quite frankly, and the impact it's having on the number of people who are buying homes, which is unbelievably low, and the number of people who are forced to sell because they're over leveraged.
And, says Posthaste, demand is just not going to be there. Despite reports that we've seen over and over and over again that rising immigration would be enough to prop up prices.
We have a ton of immigration, population's booming. But these types of factors, this imbalance between supply, demand, not enough building, these are not going to help the housing market in the short term.
As it turns out, in terms of prices, the ability to purchase matters much more than the desire to purchase.
Well, there's no way to determine that, Sam.
And Steve Soretsky said very much the same of Vancouver.
Yeah, I think in the near term, I do think interest rates, a 6.5% mortgage rate is going to trump, what's happening on the immigration side.
Yep, realtors on the news saying immigration, a lack of supply, won't save house prices.
So what are we supposed to do now?
So we have a growing number of reports of distressed homeowners who have seen their payments jump from either major increases at renewal time or from major increases due to their variable rate mortgages. And with $200 billion more in mortgage renewals coming up this year and the Bank of Canada unlikely to lower rates at least for the foreseeable future, it doesn't look like this situation is going to be getting better anytime soon. And this comes at a time when we're seeing a major increase in new listings come to the market Canada-wide. We're seeing an abnormal number of listings come to the market for the month of September. If this flood of new listings is due even in part to distressed homeowners, then these homeowners will not have the ability to wait it out. They will not have the ability simply to terminate their listings and wait for buyers to come back. All things being equal, if we continue to see a major increase in supply, due at least in part to distressed home sellers, and buyers can't or won't purchase at current prices, then prices have to come down. With all of that said, we will continue to track Canada's housing market, and we're going to have an update out on the CRA's national stats when they come out any day now. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.